Something strange is happening on Ethereum right now. The so-called smart money, long-term holders who've weathered every boom and bust, are selling Ethereum at a record pace. Their share of the Ethereum supply just plunged to the lowest level ever recorded, dropping 10% in under a year. That's over 11 million Ethereum unloaded by investors who, in the past, nailed the timing almost perfectly. Back in 2017, they sold before Ethereum collapsed 94%. In 2021, they cashed out again just months before Ethereum lost more than 80% of its value. These are battle-hardened players with track records of calling the top. But here's the shocker. While they're cashing out, institutions are loading up like never before. Public companies and treasury firms have gone on an unprecedented buying spree, scooping up Ethereum at a speed we've never seen before. In just 5 months, their combined holdings exploded from 40,000 Ethereum to over 5 million. That's not a rounding error. That's 3.5% of the entire Ethereum supply sucked off the market and locked onto corporate balance sheets. So the question is, who's right? The early adopters who built fortunes by exiting before every crash, or the billion-dollar institutions betting that Ethereum's story is only just beginning? One side is about to be proven very wrong. But before we dive in, if you're enjoying these videos, check out our free daily email, Crypto Nutshell. Tens of thousands of investors already read it every morning. In just 5 minutes, you'll get the biggest stories, the sharpest predictions, and the on-chain data that actually matters. It's fast, it's free, and it keeps you one step ahead. Hit the first link in the description and subscribe today. Now, let's get back into the video. We've seen this movie before. Back in 2017, Ethereum OGs, the people who were there from the very beginning, took profit during the ICO mania. It looked like Ethereum could never go down again, until it did. Within a year, Ethereum had collapsed 94%. Wiping out almost everyone who ignored the warning signs. Then, in 2021, it happened again. Long-term holders quietly started unloading their coins months before Ethereum topped at $4,800. Most people were still euphoric, still chasing NFTs and DeFi tokens, but the veterans were selling, and within a year, Ethereum was down more than 80%. Back then, the smart money had it nailed. They weren't emotional. They weren't caught up in hype. They sold when everyone else was still buying, and history proved them right. But here's the thing, 2025 isn't 2017, and it isn't 2021, because this time there's a new player at the table. Not retail investors chasing the next altcoin pump, not early Ethereum whales cashing out. We're talking public companies, hedge funds, and treasury firms. Entities modeled after MicroStrategy's famous Bitcoin play. Except this time, it's not Bitcoin they're stacking, it's Ethereum. And these aren't just anonymous companies. These are names everyone on Wall Street knows. Stanley Druckenmiller, the billionaire hedge fund manager who famously predicted the 2008 financial crisis, a trader with one of the best track records in history, and Peter Thiel, the co-founder of PayPal, Palantir, and one of the earliest investors in Facebook, a billionaire who built his fortune by spotting world-changing trends before anyone else. Both of them have taken direct stakes in Ethereum treasury firms. Thiel is now the largest shareholder in one, with more than 9% ownership. Druckenmiller picked up a 2.5% slice of another, and here's why that matters. These treasury firms aren't just buying Ethereum once and sitting on it. They raise capital, issue shares, and buy more Ethereum over time. Their business model compounds their holdings, meaning every quarter, every year, they're structurally accumulating more Ethereum. This isn't a retail-driven bubble like past cycles. This is capital rotation, out of the hands of early holders, into the balance sheets of billion-dollar companies, into the portfolios of some of the sharpest investors alive. So the real question is, who's really the smart money this time? To answer that, we need to zoom out. Ethereum doesn't trade in a vacuum. It moves with the tide of global liquidity. It behaves like a high beta risk asset, and risk assets live and die by financial conditions. Right now in 2025, those conditions are as favorable as they've been in years. 3 critical variables explain why. The dollar is crumbling. We've seen one of its sharpest declines since the 1970s, and every single Ethereum rally has happened during a falling dollar. Here's why. Ethereum is priced in dollars. When the dollar weakens, Ethereum effectively becomes cheaper for international investors. A German fund manager, a Japanese family office, an Asian sovereign wealth fund, all of them can buy more Ethereum for the same local currency. That unlocks global demand. And history makes the case crystal clear. In 2016 and 2017, the dollar slid lower. Ethereum went from under $10 to over $1,400. Its first monster rally. In 2020 and 2021, the same thing happened again. The dollar weakened after COVID stimulus, and Ethereum surged thousands of percent. In 2022, the opposite. The dollar spiked to 20-year highs, crushing global liquidity. Ethereum collapsed from $4,800 to under $1,000. The pattern couldn't be clearer. When the dollar falls, Ethereum soars. And here in 2025, the dollar is falling again. Oil is the heartbeat of inflation. When oil prices rise, inflation spikes. That forces central banks to tighten policy, consumer spending drops, and risk assets like Ethereum get hammered. But when oil falls, the opposite happens. Inflation eases, consumers keep spending, and investors are more willing to take risk. That's exactly what we're seeing today. Oil rolled over in late 2024, and the pressure on global inflation broke. Instead of central banks panicking about runaway prices, the conversation shifted back toward easing, and history proves the link. In 2021, oil surged to decade highs. Inflation ripped, the Fed tightened aggressively, and Ethereum crashed. In mid-2022, oil peaked and turned lower. Within weeks, Ethereum bottomed almost to the exact day. That downtrend in oil opened the door for Ethereum's recovery. Today, oil is still trending down. That's another green light. And this is the big one. Markets are now pricing in over 300 basis points of easing by the end of 2025. That's not just one symbolic cut, that's a full-blown easing cycle. And here's the kicker. Markets almost never miss this. Since 2006, Fed fund futures have been accurate 155 out of 157 meetings, a 99% track record. Why does this matter so much? Because falling rates are rocket fuel for risk assets. They mean two things: cheaper borrowing. Corporates, hedge funds, even retail investors can access capital more easily. That liquidity often finds its way into speculative assets like crypto, lower discount rates. When rates fall, investors value future growth more. High beta, high upside assets like Ethereum look dramatically more attractive. And again, history lines up perfectly with Ethereum's cycles. Ethereum bottomed in late 2018 when the Fed paused hikes. Ethereum peaked in November 2021. The same month the Fed shifted hawkish. Ethereum bottomed again in late 2022 as hikes ended, and now we're standing at the start of another easing cycle. That's not a headwind, that's rocket fuel. Put it all together. The dollar is falling, oil is easing, rates are about to drop, every signal is flashing green. This is the exact same setup that triggered Ethereum's past super rallies. And if history is any guide, these aren't just tailwinds. They're the winds that turn bull markets into manias. But it's not just macro tailwinds. Under the surface, Ethereum's on-chain activity is exploding. Transactions have surged to new all-time highs. That's only happened twice before. Once during the 2017 ICO boom, and again in 2021 at the height of the NFT mania. Both times, Ethereum didn't just move higher, it went vertical. In the first case, Ethereum climbed more than 150,000%. In the second, it surged 4,500% and set new record highs. Why does this matter? Because Ethereum isn't just another token. It's the gas that powers the entire network. Every swap, every stablecoin transfer, every lending protocol interaction burns Ethereum as fuel. And since EIP 1559, that fuel doesn't just get spent, it gets destroyed. A portion of every transaction fee is burned forever, permanently reducing supply. That means rising network usage creates a double effect: higher demand for Ethereum and lower supply at the same time. It's an economic flywheel that no other blockchain at this scale has. We've seen this play out before. In 2017, ICOs drove usage through the roof. Ethereum demand spiked, gas fees skyrocketed, and prices followed. In 2020, DeFi summer turned Ethereum into the backbone of permissionless finance. Every yield farm, every liquidity pool needed Ethereum. Prices ripped higher again. In 2021, NFTs and stablecoins pushed activity to record levels. Entire markets ran on Ethereum's rails, and Ethereum hit $4,800. But 2025 is different. Today's surge isn't being fueled by speculative fads or short-term manias. It isn't a wave of copy-paste ICOs or a handful of NFT projects. This time, Ethereum's all-time high in transactions is being driven by three powerhouse sectors with real adoption, real capital, and real staying power. Decentralized finance is back, and it's stronger than ever. Earlier this year, the SEC eased restrictions, clarifying that liquid staking tokens wouldn't be treated as securities. That one decision opened the floodgates. Since then, capital has poured back into DEFI. Total value locked nearly doubled in a matter of months, jumping from $80 billion to well over $150 billion, on its way back toward record highs. And here's the key. Over 60% of that activity runs on Ethereum. That means every dollar entering DeFi is overwhelmingly flowing through Ethereum, as collateral, as gas, as settlement. DeFi isn't just back, it cemented Ethereum's dominance in the sector. At the same time, tokenization is exploding. In 2021, real-world assets on-chain were barely measurable, just $70 million. Today, that figure has ballooned to more than $15 billion. That's a 215 times increase in just 4 years. And once again, Ethereum sits at the center. More than half of all tokenized assets live on its network. That includes tokenized US treasuries, real estate, and corporate bonds. Even BlackRock, the largest asset manager on the planet, has started experimenting with tokenized funds. This isn't hype. This is traditional finance moving on-chain. And Ethereum is the settlement layer they're building on. Then there are stablecoins, arguably the most important bridge between crypto and the real economy. After the Genius Act passed, stablecoins finally received clear regulatory backing. That one piece of legislation unlocked the path for mainstream adoption. The result? The stablecoin market is projected to hit $3.7 trillion by 2030. And right now, Ethereum already hosts over 54% of all stablecoins in circulation. That's nearly double Tron, its closest competitor. Every time a stablecoin is minted, transferred, or redeemed, it generates demand for Ethereum block space. With trillions of dollars in potential flow, that's a structural pipeline of adoption running straight through Ethereum. DeFi, real-world assets, stablecoins, 3 industries, trillions in potential growth. And Ethereum isn't just participating in them, it's leading all 3 by a wide margin. That's why today's surge in transactions is different from 2017 or 2021. It isn't froth. It isn't just speculation. It's real adoption. Adoption that burns Ethereum supply, increases demand, and locks Ethereum deeper into the plumbing of global finance. So let's go back to the central question. Yes, long-term holders are selling. And yes, they've nailed cycle tops before. But this time, it doesn't look like another bubble. It looks like rotation, out of the hands of retail, into the hands of corporates, out of old whales, into billionaire portfolios. Institutions aren't buying Ethereum because they think it'll just double and dump. They're buying because they see it as infrastructure, the financial internet for the next decade. And here's the kicker. Those treasury firms now holding 3 million Ethereum, their model compounds over time. Just like MicroStrategy did with Bitcoin, these companies issue shares, raise capital, and buy more Ethereum. Quarter after quarter, their treasury grows. And with it, investor exposure. That isn't hype-driven demand. That's structural demand. And crypto has never had it at this scale before. And if you're worried this wave of selling means the top is already in, history tells a different story. Back in 2021, profit-taking didn't end the cycle immediately. It lasted for 450 days before Ethereum finally peaked. Right now, we're only about 300 days into the current wave. By that math, the real top may not come until early 2026. And this cycle isn't identical to the last. ETFs, treasuries, and institutional adoption all extend the timeline. Instead of short, brutal booms and busts, we may be entering a stretched cycle where adoption keeps fueling demand for much longer. So yes, pullbacks will come, 20%, maybe 30%. But the odds of another 80% collapse are far lower. Here's the bottom line. The old smart money may be cashing out, but the new smart money, the billionaires, the corporates, the treasuries, they're buying. Macro is flashing green. Fundamentals are stronger than ever. Adoption across DeFi, RWAS, and stablecoins is accelerating. This isn't 2021's top. This is 2025's setup for Ethereum's next explosive leg. Volatility will happen. Shakeouts are inevitable. But in this environment, dips aren't danger. They're opportunity. So if you want to stay ahead of these signals, when institutions rotate in, when treasuries add more, and when cycle top indicators finally start flashing, hit subscribe. Because in 2025, the Ethereum story is only just beginning.